Let's discuss successful investing within the markets. It all starts with the right mindset. Now, a lot of people out there, especially retail investors, struggle to understand the importance of a clear and clean mindset to investing. What do I mean by this? This is usually retail traders that are investing money that they can't afford to lose, don't understand the emotional side of investing and how this can affect your overall trading and investing decisions. I want to talk about what creates a successful mindset for investing. We're going to be going through 20 famous investors and their successful traits that they apply to their market. This will overall help you improve your mindset when it comes to investing and ensure that your returns are maximized rather than affected by emotional traits that you currently have in your investing decisions. Most retail traders aren't losing in the market specifically due to the strategy that they're applying, but often because of the emotional hurdles that they put in place when they actually start either trading or investing. So let's see if we can break down those hurdles to improve you as a better trader and a better investor. So we're going to start off with the world-renowned Warren Buffett. One of his famous quotes that he uses is that he emphasizes the importance of how the stock market is a form of transferring money from the active to the patient. So those individuals that are sitting there trying to get in and out constantly in the markets, transferring that wealth to the patient. So if we can learn one thing from this successful trait from Warren Buffett, it's that being patient in your positions and often looking at that long-term approach is going to improve your emotional mindset rather than being stuck in the weeds of getting in and out of the market as quick as you can. Number 2 is discipline. This is a famous investor called Peter Lynch. Now, when he talks about discipline, it's about sticking to your strategy, even in the most volatile markets. Because when you stick to a strategy, you can analyze that data a lot more clearly to improve it for the long-term approach. If you're using reactive approaches based on emotional decisions, you're never going to actually be able to improve the strategy because it wasn't ever set in stone from the get-go. Be disciplined, make sure that your strategy is very much rule-based to try to eliminate those emotional trading decisions throughout your investment career. Now, the third successful investor that we're going to be reviewing is John Bogle. Now, he's the founder of Vanguard. And as an advocate for long-term investing, John Bogle emphasizes the importance on time in the market over time in the market. Again, this is really pushing that whole statement of long-term outlook. When we take ourselves away from that short-term in the weeds approach, we can see the bigger picture and allow for that to pan out. Now, number 4 is the famous investor, Charlie Munger. Now, unfortunately, Charlie Munger has passed away, but we can take away some of his successful traits in investing. And one of his main points was continuous learning throughout your entire life. Now, the importance of this helps you make investment decisions. Because if you're always expanding your knowledge base, you're going to have clearer ideas of what you like in an outlook of an investment opportunity. The more that you expand your knowledge and become more attuned to the markets, the more that these opportunities are going to start sticking out to you. So number 5, the father of value investing, none other than Benjamin Graham. Now, he talks so much about emotional control, but how does he get emotional control when he's investing in the stock market? By understanding fair value. Now, if you apply fair value to your investment strategy, it gives you a core understanding that you're buying a stock or an asset below market value. And overall, this helps control your emotional state because you know that you're buying something at discount. And again, using that as a long-term approach, knowing that that asset is undervalued and you bought it at a cheaper rate than its actual fair value. This helps with emotional control. So thank you very much for Benjamin Graham on this one because this has had a big impact in my own investment journey. Number 6, again, one of my favorite investors, Ray Dalio. He emphasizes the importance of understanding a trade before you get into that. So what does this mean? When you break it down from a risk management perspective first and understand how you're going to manage your trade, whether it's going to go good or bad, what does that outlook look like? How much money have you risked before placing that trade? And what are your expectations? Once you plan your investment strategy up front, you help define what your risk is before going into this position. And when Ray Dalio, the founder of Bridgewater Associates, says this, it's something that is worthwhile preaching and applying to your trading. Understanding risk management before you get into a trade is absolutely key. Now, number 7 is by George Soros. Some of you love him, some of you hate him. Overall, one thing that he is very good at is investing in the markets, and his key trait is flexibility. As you get new information coming out about a stock or a position, it's having that flexibility and judgment to be able to either increase your position or reduce your position based on this new information that's coming out. So having that flexibility of seeing the overall position of what's happening around your stock or the asset that you have purchased, it's very important to take this into account and then make sure that you can adapt to each and every scenario that's coming out. Have that plan in place to be able to adapt and be flexible on new information that helps us decide what we want to do with this position. Number 8 is by a famous investor known as Philip Fisher. Now he's all about research. So understanding a thorough position before you get started within the markets. Research into that company, understand the fundamentals behind it, understand the products behind it, and making sure that you break down what is their competitive advantage within their sector and how do you see this stock panning out based on your own research. Going into a trade blind doesn't help anybody. Even if you have applied all these previous steps, having thorough research into a stock is only going to allow to control your emotions a lot better from an investment point of view, because you understand the company more and more in depth. And therefore that gives a certain level of comfort when you're actually investing. So thanks so much on this one to Philip Fisher for thorough research. Another famous investor known as Seth Klarman. Now he talks also about value investing, but from a different approach from Benjamin Graham. What he talks about is having a level of comfort knowing that what you've bought is below market value. And how he looks at this is giving you a margin of safety. Now, if you take that into account into your investment decisions, we can reduce that emotional effect on our investing by seeing that we've bought this undervalued, and that gives us that margin of safety to go, how much further can this go down, knowing that we've bought this already at a vast discount. Number 10, one of my most famous investors that I like to follow, Bill Ackman, who just recently endorsed Trump after the assassination attempt. Very interesting there, but one of his most famous traits that he applies to the markets is focus. Having a deep focus on few investments rather than spreading yourself too thin. Now this is very, very true when it comes to emotional investing, because when you spread yourself too thin, you don't have time to do all those previous traits like thorough research, like value investing, understanding the theory behind it, because you're so spread thin. This goes for individuals that are trading Forex or stocks, because if you're trading multiple pairs in Forex, you're also spread too thin from being able to monitor fundamental news releases and understanding a core development of what's supposed to be happening with that individual FX pair or stock. So focusing on fewer assets or Forex pairs is super important rather than spreading yourself too thin and not understanding the full picture of what you're investing in. Another investor that we're going to be looking at is called Howard Marks, and he talks so much about contrarian thinking. So contrarian thinking is going against the overall herd and position, and this falls in line with a lot of successful investors, because most people, when the markets are selling off heavily, this creates opportunities because everyone is following the herd and they're selling out of fear and panic. Whereas if you think with a contrarian mindset, you're going to start looking at all of these previous traits, such as focus, such as fair value. And when you can take that step back and have a contrarian thinking approach to go against the herd, to look at the core reason behind the sell-off, then that's going to put you at an advantage and give you an edge in the markets. So start trying to think against the herd and not following the herd, and overall take into account a contrarian mindset. Super valuable to you, and it will overall help you control your emotions by taking an outside look at the situation rather than being a sheep. The next investor that we're going to look at number 11 is John Templeton. He talks so much about humility. Now, some of you revenge trade, get into the markets and keep on trading. Humility is all about understanding when you are wrong, cutting your positions and retuning where your focus goes within the markets. If you can take into account this successful trait of cutting your positions quickly and allowing for your winners to run, you're going to start controlling your emotional mindset when it comes to trading and investing. If you can admit those mistakes quicker, cut the loss shorter, and focus on those successful positions, you're going to be in a better mindset for investing. Number 13 is David Swensen, who's the Yale University Endowment Manager. So he looks after a large amount of money. He talks heavily about diversification to increase your chances of steady returns. So making sure that not all of your eggs are in one basket. Let's make sure that we diversify them across different sectors and different ETFs to ensure that we have a steady return. Time to review that portfolio and not focus on just one asset class, but time to broaden that horizon to create steady returns. Definitely an investor that we want to listen to. Another one of my famous investors that I like to follow is James Simons. He's the founder of Renaissance Technology, huge performance, over 20% per annum, and he's a quantitative investor. So he looks at very much an analytical approach, pushing those emotions to the sideline and looking at the facts and figures behind the company and the reason behind investing. If we can start putting more rule-based investment rules in place, then overall we're going to push those emotions to the side and follow our rules. This is Renaissance Technologies, and I highly suggest looking him up because James Simons is a renowned successful investor and a trait that I've applied to my investing journey. We're now on point 15. We're going to be talking about Cathie Woods. A lot of you know this individual from her crazy investment journey. Now, what do I mean by this? She has been involved and invested in new cryptos, in Tesla, pushing out the boundaries of investing in new technology. Her plan in investing is all about staying ahead of the technology curve. What is the next big technology that's going to be implemented into society? Her portfolio is arguably very up and down, but when she gets one right, it's hundreds of percentage points. This is something to take into account and maybe look from a higher level point of view on her investment journey and take away the fact that she's looking at new trends within the market and what value that could add. Specifically, if we look at how much AI has been adopted within the markets and within companies, staying on top of that edge could pay off huge amounts in the future. So number 16 is by the famous investor Carl Icahn. He talks so much about conviction and taking an activist role within your trading. So overall, we can't go down the route of corporate raiding, such as what Carl Icahn is known for. However, we can take conviction and an active role in our trade or in our investment. And what does this mean? Again, it's coming back to understanding the full picture of how do we take this investment opportunity and understand the full information behind it to become comfortable enough to not allow that fear and greed emotion to take place in our day-to-day trading. Number 17, another famous investor called David Dodd, and also a joint author with Benjamin Graham, talks about ethical investing. Now, this may not be for all of you, but understanding the ethics behind a company and how they make their money can be an important point for long-term wealth. Obviously, when we're talking about generational wealth, you know, those younger generations may not be happy with how that wealth was created when you was doing the investments initially. Again, this is a lot more longer approach in how it can affect generational wealth, and it may not be one for all of you, but understanding the ethical side of the company behind that you're investing in is super important, because if you can understand and be happy with the ethics of that company, then overall you're going to feel a lot better about your investment and overall back it even more. Now, this is so true when it comes to that long-term approach, because sometimes if you're investing into a company that's got a bit of a bad name in the media, or they're not doing things necessarily in the right way that's seen from a community standpoint, it can affect your emotional stance on that investment. So if we can put ethics first in investment, and not always will you be able to do that, but if you can, then it's also going to help with pushing those emotional feelings that might come in later down the line once you have been successful in that position. Number 18 is by famous investor Stanley Druckenmiller, and it's all about curiosity and understanding the macroeconomic environment and how we can utilize this to our advantage. If we can understand this business as much as we can, then overall that curiosity is going to spark investment ideas and how we can take advantage of this opportunity that we've found. If you can understand that macroeconomic environment, it's going to give you what I call an edge, and we're always chasing this edge within the market to put us above other investors. And again, it's only going to help you with your emotional state because you understand understand a lot more about the position that you're investing in. Number 19 is by Paul Tudor Jones. Now he again is a great investor and he talks so much about resilience, and this is something that you're all going to be able to relate to. We've all had setbacks in investing, in trading, day trading, FX, you name it. We've all had setbacks, and it's about having that resilience in play to understand that you've had a setback and now you're about to go on forward and take a huge leap. And again, you could do very well from that. Don't let these setbacks push you back to the ground and give up on your investment journey. You've got to imagine that all of these investors and all of these traits that we're talking about have all had setbacks. And the one thing that we want to put in place is resilience. Understand that it's just a setback. It's not game over. You can always come back from a losing position. So start building up that resilience, because the more resilience you have, the more you're going to be able to tame that emotional mindset. And the last and final one is by John Neff, and it's about networking is your net worth. So being around other successful investors is only going to help with your mindset and your approach to overall opportunities in the markets. Now, networking is so key for me because it gives me these different investment opportunities, these different investment ideas that I necessarily would have missed. And I don't want to miss out on these opportunities. And so listening and understanding maybe other investor setbacks can help me from avoiding those setbacks or potentially enjoying and being a part of these new investment opportunities. For example, you should look at joining our weekly lessons, because if you join our weekly lessons, you're going to be seeing a lot of investment opportunities that I'm involved in, why I'm taking them, how you can take them, how you could be involved in that. And by being around like-minded mindset individuals and like-minded successful investors is only going to improve your journey from an investment standpoint and an emotional standpoint. I hope they help you in your journey. Please hit that subscribe button, it helps the channel. And overall, if you want to join me on our weekly lessons to discuss investment opportunities and what we're focused on in the markets, then click the link in the description and come and join me and see what it's about. Overall guys, thanks for watching, and I'll see you in the next video.